Kia ora, and hello. Welcome back to the channel. The foundations of much of our modern economies, be they the macroeconomics of nations or the microeconomics of businesses and households, rely on the use and trade of debt and credit. Debt and credit are seen as a necessary evil and, to a degree, something to be avoided. Governments are to avoid deficits and debt, while households and banks, on the other hand, are taking and giving out credit and debt. Repeated shocks to our global financial systems have made people debt averse, while on the other hand, taking on mortgages, credit cards, loans, payment plans, and other credit instruments. These instruments, which we rely on to fill the gaps in our finances, be it the government to raise funds for capital expenditure or businesses to take out loans to expand production, have lines of credit for wages and operating costs, or individuals taking out credit cards, mortgages, or payday loans to make ends meet, are engaging in an economic practice whose origins lay very deep in the medieval period. I'm sure we've all heard that offering loans was banned in the medieval period. I mean, we all know that the church banned usury, and as we say around here, it is known, leaving Jews to be moneylenders since Christians couldn't loan to each other. However, as with those oft-repeated falsehoods regarding the medieval period, and frankly, falsehoods regarding Jewish people. But when we take a moment to do some thoughtful investigation, none of this holds much water, especially considering the medieval period was, after all, when banking was invented by the Italians. If by now you cannot tell, in this video, we will be discussing medieval credit and debt. And this is going to be a hefty one, to be honest, folks. So please, if you want to know more, have a look at all the sources for this video down below. Hi, I'm Andrew, and this is Popular Urbanum, a show where we discuss reenactment and the medieval middle class. Credit was an important part of the medieval economy as it is today. It took many forms and used varying instruments, which we still utilize in our modern financial systems. Some you would be familiar with, others only if you work in the financial sector. The use of medieval credit and debt was key to the development of the medieval commercial revolution and the formation of the modern state, which has its roots in the medieval period. Credit, both large and small, was important to pay for many different costs in medieval society. For the state, it allowed the raising of capital for war, investment in capital infrastructure, and emergency funds for famine relief. For the merchant, it allowed for the movement of funds without the need for cash, business loans, or the purchase of goods for sale. For the private individual, it allowed for small loans for dowries, lines of credit to purchase clothing and essential items, and mortgages for the purchase of land or houses. For rural workers, this allowed the purchase of seed, livestock, tools, or land for farming. Importantly, credit and pawnbroking was seen to aid those in financial distress, providing an alternative to charity through distress loans. During the late medieval period, coinage was scarce, leading to the 15th century bullion shortage and subsequent Great Slump, that long period of economic recession of the 15th century. If you'd like us to do a video on the Great Slump, comment below and let us know. During this period, the use of credit or bonds of sale became even more important, as did those with liquid funds to offer credit to a cash-strapped government and populace. Medieval debt and credit operated through a highly legislated market. The most obvious form of ban or regulation would be the church ban on usury, the extraction of interest or any specified return beyond the principal value of a loan. The corpus juris canonici, the body of canon law, defines usury as whatsoever is extracted beyond the principal, be it money, grain, wine, or oil. As such, usury legislation can be found throughout the whole of Europe through the Middle Ages. Often, Aristotle's natural law and the inherent sterility of money is quoted by the Church when debating usury, which said, "The most hated sort of money making, and with the greatest reason, is usury, which makes a gain out of money itself, and not from the natural use of it. For money was intended to be used in exchange, but not to increase at interest. And this term usury, which means the birth of money from money, is applied to the breeding of money, because the offspring resembles the parent, whereof all modes of money making, this is the most unnatural." Both theologians and jurists regarded the interest on a loan as a sin, not only against charity, but also against the commutative justice and natural law, and thus a mortal sin. It was even a mortal sin for the lender to hope for any payment and interest. Civil law, however, was more lenient than canon law, allowing interest to be charged under certain circumstances. Following Roman law, loan contracts, mutuum, were supposed to be free. Therefore, other contract forms like verbal agreements, stipulatio, deposits, depositum, exchanges, permeato, or partnerships, societas, were to be used to charge interest. So, understanding this, we can see that there is a ban. But credit is still being applied, though we cannot see exactly how credit is being used. So, let's examine some of the instruments and ways medieval society utilized credit. First, let's have a look at bills of exchange. Medieval merchants were not inclined to transport coinage with them over long distances, instead preferring the use of a bill of exchange, a form of credit which would allow the holder to draw down into coinage the promised sum at the end destination. This allowed the holder or drawee to take a bill signed by a drawer who had agreed to an amount of the money to be paid to the payee, who is an agent, a money changer, or has a contract with the drawer to issue the funds for the agreed amount of money. In international trade, this allows for funds to be issued in local currencies at the destination, often with conversion rates factored in, allowing for any interest to be calculated into the transaction and disguising of any usury prohibitions. Additionally, merchants could purchase a bill of exchange from other parties at continental fairs or money changers at Brugge to move in the opposite direction they came, so both goods and credit can move across Europe. Say, for example, I took a bill of exchange from Florence for, say, 1,000 florins. I signed this off by my boss to be paid in equivalent exchange in Flemish groats to his agent when I arrive in Brugge. I take the coin, and when I wish to return home, I purchase another bill of exchange for the return trip to be paid in florins when I arrive in Florence. As noted in their paper, The Non-Use of Money in the Middle Ages, this is the heart of the idea that a sufficiently extensive market in credit instruments could all but replace cash as a medium of exchange. The use of bills of exchange is mostly associated with Italian merchants and extensive clearing with the Italian and Flemish money changers or the continental fairs, and is in reality a medieval financial exchange. Beside the use of bills of exchange, promissory notes were also a form of credit utilized in mercantile transaction. Unlike the bill of exchange, the promissory note allowed parties to borrow money, a debt, or pay for goods in the future. A promissory note allows parties to agree on payment terms such as a date of payment, fines and penalties, installments, and so on. These promissory notes would also be traded and sold in exchange for loans and goods, with the final holder of a note being paid by a second or third party on the initial debt. For example, Humphrey de Bohun and his companions had incurred a debt of 2,600 ecus while crusading in Prussia in 1362 to 1363. To settle this debt, they entered into two bonds obligatory with Prussian merchants, the first with Henry Schlonhals and Matthias Wise of Thorn for 1,600 ecus, and a second for 1,000 ecus with Gerhard von Allen. Both bonds were sealed in early January 1363 for repayment in Brugge and Easter. We also know that the first bond was repaid not by Bohun himself, but by a London woolmonger, Thomas Albon, in Flemish Groats. Albon took the Bohun bonds from the Prussians back to England, where he was presumably repaid by Bohun. Unlike larger commercial loans and exchanges, smaller domestic loans and lines of credit were also common, either to offer payment for goods, borrow money, or as payment for services. These lines of credit could be traded much like commercial loans. In England, it was illegal to transfer a debt. This was avoided by having a debt de facto appointed to an attorney. This attorney could then become a default third-party creditor, allowing the attorney to hide the transference from the courts if they should have to take legal action to recover the debt. A London case of 1396 suggests there could be a chain of such appointments. William Prodholm of Burton-on-Trent issued a letter of attorney to John Sipston, citizen of London, and John Bullock, empowering them to receive from the Society of Ancient Albertines of Florence the sum of 312.5 nobles, 2 shillings, 8 pence, due on a bond from the Society of Thomas White and John Dalston, for which Prudhomme himself had a letter of attorney from White and Dalston. Or, in 1365, for example, William de Wheatley bought goods worth £29 from Alice, widow of Henry Skett, a cordwainer, for which he paid just under £20 in cash, and made a tally for the remaining £9, 8 shillings, 11 pence. Later, by order of Alice and her new husband, John Winslow, Wheatley paid the latter sum to John Cannon, a creditor of the late Henry, and the tally was cancelled. Not only did this credit economy exist in urban economies, there is evidence of credit in the rural economy, with peasants having access to credit and a credit market. This credit market relied on rural credit being distributed widely to reduce any financial shock that may impact the small rural economy, often with loans being distributed widely to kin and strangers and outside of the local economy. This market would, instead of entailing written instruments, be made of pledges of credit, any records existing only in manorial suits. One such suit was dated May 1277 from Heacham, Norfolk. Richard Marth sued Edmund Caperon. Richard claimed that shortly before the previous Christmas, in his house at Ringstead, some 3 miles from Heacham, he had sold stockfish worth 18 shillings to Ralph Levinter. Clearly, this was a credit sale with payment deferred. However, Richard had refused to deliver the fish to Ralph until he had a good pledging. Edmund had then come before Richard and undertook to pay the 18 shillings purchase price if Ralph failed to do so. Dates for the payment were agreed, but Edmund, Richard claimed, had failed to pay the dates agreed, hence the lawsuit for recovery of the 18 shillings plus damages. Court rolls show that these pledges of credit often have credit being issued to non-manorial residences, pledges being sold, or liability being transferred to other parties. Such is in the case from the Manor Court rolls from Oakington. It appears the inquest jury in which Robert Swan, plaintiff, and William Tiller place themselves that the same William owes 2 shillings 8 pence as pledge of Simon Thresher, as Robert complains against him with damage taxed at 3 pence. Therefore, it is considered that the said William shall be in mercy, i.e. fined, and order is made to levy. This demonstrates that, as with urban environments, rural markets are actively engaged in the use and trade of debt, although there is little evidence that rural people did not also use other forms of loans or credit. We now come to the part of the video topic where we cannot discuss medieval credit without looking at the role of the Jewish community in medieval moneylending. Be it the historical role or the modern discourse and rhetoric of the Jewish moneylender and banker, this is often misrepresented and used as a dog whistle. I am by no means an expert in the medieval Jewish community, and most likely will make more than one mistake. I cannot, however, discuss medieval credit without including the important role the Jewish community played in the credit system, being that the medieval Jewish community was not considered part of the Christian community, that they were unable to join many guilds and engage in many Christian trades and businesses. Though being able to charge interest and engage in usury afforded them the ability to lend money openly, where Christians would need to hide interest or face hard lending scrutiny. This meant that many Jews would engage in money lending and pawnbroking due to job restrictions, and they would often be invited by the state to engage in money lending. That is not to say that Christian lenders did not exist, as they were established all over Europe. Money lending, especially at interest, was an important economic activity. In the Italian cities, Jews could settle and lend through what was known as a condotta, a long-term contract between the town governments and the lender. These contracts could last between 5 and 20 years and were renewable on expiration. Interest ceilings were set by the town governments. Jewish lenders had to pay an annual tax and lend to the commune. The tax was not proportional to the profits earned, but specified in the contract. Being holders of these charters, Jews held monopoly rights over pawnbroking in the communes. The charter set the regulated interest ceiling. This ranged from 60% per annum in Città di Castello in Umbria in 1402, to 42% in Spoleto in 1416, to 30% in most Tuscan towns in the 15th century, to 15 to 20% in most towns belonging to the Venetian terra firma during the same period, down to 10 to 12% in Venice itself in 1382. For collateral, people could borrow by pledging movable objects such as clothes, shoes, jewels, and tools as pawn. Otherwise, they could write a letter of promise, either by writing or by the borrower or by a notary. Jewish moneylenders were prohibited from mortgage lending as they were considered foreigners in the city-states, and the city wanted to prevent them from holding large land holdings. Although Jewish moneylenders were invited to offer loans to both state and private citizens, often with the view this was providing a much-needed service, both providing a ready source of liquid capital for the towns and small loans and pawn services. Yet this tide was turning. The Franciscans and the Dominicans began a campaign of anti-usury in the early 13th century. They were aided by the Fourth Lateran Council, which issued a diatribe against Jews for treachery and cruel oppression in extorting oppressive and excessive interest, while engaging, as non-Christians were allowed to do, in licensed pawnbroking. By so associating usury with Jewish moneylenders, the council turned it into a more heinous mortal sin in the eyes of a largely anti-Semitic public. The friars found more ammunition in the decretals that Pope Gregory IX issued in 1234. After confirming the Third Lateran's Council decree of 1179 that had excommunicated usurers and refused the unrepentant burial in consecrated ground, the decretals required princes to expel usurers from their territories and never to readmit them. In addition, the Franciscans and Dominicans contrived their own stories about the ghastly fates awaiting usurers after death, and by their incessant inflammatory preaching, convinced most people that usurers were linked with the worst evildoers, the worst occupations, the worst sins, and the worst vices. In the Italian towns, this resulted in the creation of the Monte di Pieta, charitable trusts which would offer small loans and pawnbroking, charging small interest from 5 to 15% per annum. However, the Monte di Pieta could not service large loans. Additionally, the Jewish pawnbroker was not an unwanted service. Instead, they were seen as a public good, being able to provide debt relief for the poor. When a petition was made to invite a Jewish lender into a town where there was not one before, one petitioner would comment on how the poor suffered without being offered the benefits of a Jewish lender. Though loans to the poor may not have been the only reason to invite a Jewish lender, small loans was not the only service they provided, as previously discussed. By being able to provide large capital to merchants in the state allows for easy finance, though they did not dominate the credit market. For example, a survey of Tuscan towns in 1427 found that Jewish moneylenders held 10.3% of the debt at any one time. This is not an insignificant market share, though the high interest of the Italian cities is not indicative of the Jewish money lending and the only place that interest and money lending took place. So what of interest? We've spoken about credit, but if interest was a mortal sin, how was interest applied? And how much was charged? It is difficult to extract in those cases when interest was allowable because the church was endlessly debating what was reasonable interest and profit and what was considered sinful in these matters. While those contracts where interest was not allowed, then the interest would be hidden, meaning often we cannot tell how much was being charged. The ways interest was hidden were different. Interest could be hidden in contracts, such as setting damage on failure of repayment, setting an unrealistic repayment date, and then charging damages and costs to be repaid. Interest could be hidden by recording a higher amount in credit than what was provided and claiming the principal and interest together, often by taking the debtor to court and presenting paperwork with a higher principal than what was paid. Or, in the case of property or business being used in collateral or mortgage, providing any rents as a gift to the creditor. There are other situations, such as with Christian and Jewish professional moneylenders and pawnbrokers across Europe, who could charge interest if they were sanctioned. In Triol, such enterprises were called casanas, run by Italian moneylenders, who had to make annual payments to account for the right, which counted as a leasehold and had regulated interest rates. This is the case for the casanas in Riva, Miran, Sterzing, and Bozen. In the charters of Miran, Sterzing, and Bozen, the maximum interest allowed to be charged at a fix of 4 denarius per pound per week, equivalent to 86.6 per annum. In Riva, locals paid only 2 denarius per pound per week, while foreigners had to pay the usual 4 denarius per pound per week. Thus, the interest charge was between 43.3% and 86.6% per annum. The pawnbroking banks lent money against pawns and other securities and spread over large parts of the country throughout the 14th century. From the middle of the 14th century onwards, several of these institutions were already closing down, either due to mismanagement or for political and economic reasons. Like the casanas, Jewish moneylenders offered financial services both to the counts of Triol and the population. Before the 14th century, there is little evidence of a Jewish presence in Triol. Later, Jewish families moved to Triol and settled mainly in the larger towns. Some of them also entered the pawnbroking business and leasing some of the Comtal casanas, sometimes in cooperation with Christian moneylenders. King Heinrich of Bohemia, the Count of Triol, called Jews from Sieverdal to settle them in his lands. In a charter, he put them under his direct protection, guaranteeing them a monopoly on money lending. This professional money lending against interest required the permission of the authorities, be it the Count of Triol or the bishops of Trient or Brixen. The oldest known Ordnung of 1403 from Bishop Ulrich of Brixen regulated money lending activity of the Jewish community. The charter follows up on existing legal ordinances and fixed the maximum interest rate charged by Jewish moneylenders at 4 denarius per pound per week for local residents, or 86.6% per annum. From strangers, they are free to demand whatever they agree with them. For those not engaged in legal or regulated money lending, interest was still charged. As was a case from 1236, Ilteprandus de Firman, Utis, and Arnaldus de Mecco promised to repay £126 until a certain date, otherwise they would cover damages and expenses incurred to the creditor. The interest they were obliged to pay was defined in the contract. They swore to pay 50 soldadus per month until the debt would be satisfied, equating to roughly 2% per month or 23.8% per annum. In another loan contract from 1237, Arnoldus de Walchestein and Hermanlindus de Costropdo promised the payment of £20 for the purchase of 2 horses with saddles until a specified date. Once again, the debtor swore to pay interest of 20 solendus per week or 5%, totaling 260% per annum. In these cases, no penalties for usury were brought on the creditors, even in the case of a 260% per annum interest, although cases were brought against creditors for usury. In July 1328, the Bishop of Chur appointed arbiters to decide on a usury case in Partschens, where that was brought to the ecclesiastical court. Here, a woman, not mentioned by name, accused Waltherus de Partschens and his son of hidden usury, and that he squeezed hidden usury out of her. Women pledged 2 vineyards to Waltherus and his son, and they received an annual rent of 3 cartloads of wine from it for 10 years. The arbiters ruled that Waltherus and his son were to pay 10 groschen to the daughter of the woman mentioned. As we know, extracting rent as a gift was a usual way to hide usury. Why was this not acceptable? Why did the unnamed woman pay for 10 years before the case was brought to court? Can we look at the case and see that her daughter was paid damages and not her? Was this the matter of an estate? Was it only on the death of the unknown woman that the estate sought to dissolve the mortgage and took the case to court? It doesn't say. We'll never know. Due to lack of coin in the medieval period, and the fact that poverty was all too common during this period, see our video on the medieval poor for more information. As it was all too easy to take out credit, it was also easy not to pay debt. Debtors would often be faced with the all too terrible burden of fines and seizure of goods, with these goods to be auctioned off to settle any debts. Many people being served by the sergeant or debtor seized goods and payment, which sadly, these being the abject poor. But the wealthy were also visited for non-payment. This is because people were property rich, but money poor, usually investing their wealth in goods, furniture, clothing, jewelry, belts and fittings, weapons, tableware and linen as a way to store their wealth. Often when debt showed up, people were reluctant to sell their items and settle their debt, which resulted in the seizing of their property. We see items being used as collateral for loans, such as in the case in 1335, in which Nuchora sought to borrow 2 florins and was incarcerated by her debtor for failing to pay her debt and keeping the collateral. Under penalty of 25 lira, Boniver must pay the sum within 10 days. For these florins, Nuchora has in pledge a woman's cloak made of blood-red serge with a lining of sendol in the colour fettuccine. If it has not been redeemed within the time stated, Nuchora, with the consent of Boniver, will be able to place it in pawn or sell it without first acquiring any license from the court. We see in the case of Boniver here, creditor often have the right to seize goods, and in this case, incarcerate Nuchora for non-payment without the action of the courts. As long as the contract or pledge has specified these terms, then the creditor has the right to seek recovery. Like poor Nuchora, many debtors have their items seized, commonly not just high-value items such as jewels and clothing, but foodstuffs would be seized by creditors in lieu of payment, as well as grain casks, oil amphorae, meats and cheeses and wines. All these items held high value in medieval markets. It is clear that credit, debt, loans, interest rates, and debt recovery were a large part of medieval life. I was not able to cover even a small part of the things I would like to have, as is usually the way of these things, preferring to instead give an overview of the matter. And if you want to know more, I really encourage you to look at the excellent papers that I've read while putting this video together. If anything, while researching these videos, I've come to find that again, medieval people were at the forefront of the creation of capitalism and were struggling with the very same issues we do today. In this case, needing access to credit to be able to pay for their expenses, many accounts having people buying items and issuing promises to pay some now, pay some later, or borrowing money for tools, or promissory credit for materials to complete work. Then on the other hand, we have people purchasing debt with no doubt to earn the interest, be it hidden or not, as a form of medieval passive income. And as it is also true, as it is now, that credit was used as a form of money alternative, where instead of trading both locally and internationally in money, credit was used, with payments being deferred, paid in kind, and with the trading of debt and credit instead of using cash money. For all the ideology and religious fervour against using credit and usury in the medieval period, is more than safe to say that it is more than a necessity, and it was welcome and practiced by all.
Oh, hi! We didn't see you there. That must mean you enjoyed the video. So, like, comment and subscribe. And remember, stay safe, have fun, and keep reenacting.